Hello, welcome to another edition of Nucleus Investment Insights. We saw the RBA cut some rates during the week. I thought best to have another look at the housing market. There does seem to be a lot of positive signs. We've got Leith on board. He's just written a couple of things on. I've just written a longer article on macro business about it, and obviously he's got his finger on the pulse here. So I thought it well worth grabbing him to have a bit of a chat about the housing market, what it means for Australian investors, and where that sits versus other assets at the moment, especially given all the excitement going on internationally in terms of, and what's happening with Trump. So no further ado, welcome aboard, Leith. Good to see you again.
Yeah, g'day, Damien. Thanks for having me.
Yeah, excellent. Just a quick reminder, everything you hear today is general advice, not personal advice. If you do want personal advice, you can jump onto our website and book yourself in for a call, and we'll talk to you about what might be right for you from what we're hearing today. So, Leith, we've got a bit of a slide pack. So, actually, let me just grab the. So we've got an AI Leith as well. That's just. Looks better looking. He's got better skin than you, Leith, I think.
He does, yeah. Nice and tanned. No chicken pox scars and other blemishes.
Yeah, that's right. Just need to ask our marketing person to just put some hair in for you next time. Yes. Agenda. So we wanted to look at the outlook, current Australian affordability, why Australian house prices are looking like they're going to rise, and then some of the investment implications from this. So we'll start with housing affordability. Worst in history.
Yeah, it is. Unfortunately, Australian housing affordability, no matter which way you cut it, is arguably at its worst in recorded history. So I've included a fantastic, single graphic which comes from CoreLogic, or I think they're now called Cotality, and it basically summarises the situation at the end of 2024. And so nationally, Australia's dwelling value to income ratio was 8 times at the end of 2024, which is the equal highest in history, and that's up from a decade average of about 6.7. And it was roughly 3 times back in the 90s or in the early 90s before the housing market started to take off relative to incomes. The percentage of income required to service a mortgage as of the end of 2024. Now, noted this is before the RBA began its interest rate cutting cycle, but that was the highest on record at 50.5%. So we're talking about new mortgages here. So if you're trying to buy the median priced home with a median mortgage on a median income, the typical Australian buyer would have been sacrificing 50.5% of their income just to meet their mortgage repayments, which is quite ridiculous. And the number of years to save a 20% deposit was at an equal record high of about 10.6 times nationally. And finally, on the other side of the ledger, if you're a renter, the situation was also terrible. So following, a circa 50% rise in asking rents since the pandemic, the proportion of median income to rent the median priced home was the highest on record at just under 33%. So, no matter which way you cut it, Australia's housing affordability stinks. Obviously, with interest rate cuts, the percentage of income required to service a mortgage would have fallen because we've had 2 rate cuts since then. Obviously, Tuesdays wouldn't have been passed on yet, but will be in about a month's time. So that picture should improve. But as we'll discuss, obviously, cuts to interest rates also means higher house prices. So, the structural affordability will likely get worse as house prices continue to rise faster than incomes going forward, which just means that dwelling value to income ratio is likely to climb from its current record high of 8 times.
And I think for me, one of the things I sort of, focus on for housing is there's sort of 2 parts to this, isn't it, in terms of an interest rate cut. So one part is when interest rates get cut, that's great for everyone who's got a mortgage in terms of, you see that if you're on a variable rate, you see that flow through straight away. The other part is saying, well, houses though are probably not priced by people who already have a mortgage. They're priced by people who are buying into the market, and from that perspective, it's hard to say what an interest rate is in terms of, we in terms of our definition tend to try and use, look, if somebody turns up to the bank, they're probably going to choose between the 3-year rate and the variable rate. and they're probably going to pick the cheapest one. That's our sort of our rough thesis on this is that, look, hey, people don't really know, and clearly, from what we've seen recently, the RBA doesn't really know either. So that's sort of been out there in terms of their statements. And so from that perspective, the 3-year rate for us is probably the one that you want to be looking at, and that has been coming down already. Like that's already, in the last month, sort of in April, it sort of already started to fall. Like it was, the 3-year rate was sort of, I don't know, for an investor, was sort of hit almost 7% at one stage last year, and it's down to 6.15 at the moment. So there's sort of already been a bit of this cut. And then if you looked at the sort of standard for an owner occupier, it sort of peaked as well. It was 3-year, peaked to sort of 6.8, and it's back below 6 now. So, there's there's already been some cuts, I suppose. Like there's sort of these two parts about, which is the most important. So, I know what your thoughts are on that, Leith.
Yeah. I mean, certainly, I obviously haven't been in the market to buy a home for over a decade, so I haven't experienced that. But logically, you'd think that if you're going to go up and you're going to look to purchase a home, you're going to try and. Although what I will say though is, if you won't necessarily pick a 3-year fixed rate, because if you think the interest rates are going to fall going ahead, so for example, if I was buying now, I probably wouldn't pick a fixed rate, because the financial markets, are tipping 3 more rate cuts this year. Most economists think, more than next year. So you got to weigh that up as well.
But I guess that's the thing about saying, like from April anyway, the RBA's sort of feel for it. And I know whenever I talked about these, people talk about, oh no, I can get a better rate from my bank, and you probably can, but their standard one for standard owner occupier discounted variable is 6.55, and your 3-year fixed rate is 5.94. So you're sort of getting 60 basis points off. And so I guess what I'm getting to from that is if you're scraping to get to the next, you're scraping to get the house you want, or trying to chase the price, is you're like, well, I could go with a 3-year fixed, so I can afford it, and get through.
It's also that bird in the hand's worth 2 in the bush, right? So as rates come down, your borrowing capacity goes up.
That's right.
So you can borrow more on a fixed rate of 3-year fixed rate at 5.9, for example, than you probably can at a variable rate at 6.5. Because the way they work out the mortgage serviceability is they work out how much you can borrow partly based on the interest rate.
Yeah, and I think as well, like, talking about, there's some good commentary out there from people just about how people choose housing and stuff like that, and it's that part where it's very different to a lot of other things. So if I want to buy myself a hamburger, I don't start with what's the most expensive hamburger I can afford. Now let me go and filter, and I'm going to cut out all the ones that are cheaper, and I'll just get let me go to the top of the line hamburgers. It tends to be whereas housing is exactly that way. People go, oh, what can I afford? Oh, I can afford to spend 1.5 million. Right. Set my limits. That's what I'm not even going to bother looking at houses cheaper than that and more expensive. But that's, here's my band from where I'm choosing from, and then, chasing higher and stuff like that. So there's certainly some parts for that. Okay. So housing affordability, looking poor. And that tends to flow through to rising prices as we spoke about. So as you, so we spoke all those charts, most of them, the interest rate is a measure that goes into that. So what can I afford? And that's what, we sort of choose to look at that very much as well, is that I think the house price to income ratio is sort of interesting in a way. Yeah, you got to save you got to save up for it and all that type of stuff. But that's a one-off. I can beg, borrow, and steal, or whatever it is to get that mortgage. It's actually more about the ongoing repayments that we sort of figure is into the housing prices. And so on that one, you're talking either the mortgage payment versus your rent payment. So if I can rent a place for half the price of a mortgage, maybe it's going to be more attractive. Whereas if the cost is about the same, a lot of people are going to flip and say, well, if it's costing me the same to rent as to have a mortgage, I may as well buy. And then the other one is your mortgage cost relative to income. And as we said, people are just, they're going to spend as much as they can afford to spend on that part. So, so if we're looking at 3 more rate cuts, that's obviously quite positive for houses. Any thoughts on sort of, so you've got a chart here on the change in house price in the 2 years after the start of a rate cut cycle.
Yeah, so that was compiled. That was published on the AFR yesterday, and basically it studied, the response to house prices 2 years after previous rate cuts. And as you can see in the chart, it's fairly strong most of the time. And obviously, in the post-pandemic period, we got an absolutely massive surge in house prices. So this time around, affordability is stretched. Prices are already incredibly high. We probably won't get as big a uptick. And also, the rate cuts probably aren't going to be as deep as they were during the pandemic. So, financial markets are tipping 3 more rate cuts this year. Now, that is an estimate that changes with the wind. So after President Trump announced his Liberation Day tariffs, I think financial markets were tipping, I think it was up to 5 rate cuts, including Tuesday's 5 rate cuts, so 4 more.
Yeah.
And then about a month ago, before Tuesday's meeting, they were tipping 2 more after the one we just had on Tuesday. And now, following, Governor Michelle Bullock's somewhat dovish statements, saying that, in her media release following the RBA meeting, whereby she said they consider a 0.5% rate cut and they're more concerned about the external environment. They think they're beating inflation, blah, blah, blah. The financial markets lifted their rate cut prediction to 3 more this year. So, it does change with the wind, but I think we can be pretty confident that we're going to get rate cuts over the next, certainly the rest of this year and possibly next year as well. And that therefore means, so if we've got 3 rate cuts, it basically means you're going to have a 12% decline in your monthly principal and interest mortgage repayments. That obviously increases your ability to pay, increases your borrowing capacity. It's going to suck more people into the market, logically, as it always does. And pretty much every time that rates have been cut, we've had a corresponding rise in house prices, as that chart shows. So that is obviously a very bullish indicator for house prices, the fact that interest rates are coming down.
Yeah. Now, a bunch of questions flowing through on this, which I think are probably worth actually answering now as we're talking about it, because I think there's a few things like this that flow through. So one was question just talking about how long before the rate cut flow affects mortgage rates and demand. I think it's safe to say that, look, for a lot of these, the effect on the downside for people, so there's 2 parts in my view. Is one is, what's the effect on existing people who have a mortgage? Now, that can take a while, and actually history sort of says that often people just don't even bother changing the payments. They're actually trying to use this to get ahead. So when I'm already paying whatever, $5,000 a month to pay off the mortgage, you get a rate cut, and now I only need to pay $4,900 or whatever. Is that people just go, no, I'll leave it at 5 and I'll just get in front. It tends to happen. But the flip side is it happens relatively quickly that you see because banks will relatively quickly you'll see that, okay, for new investments now I can afford to get a higher price, and so will they chase it higher? And so that happens sort of within a month or 2, I think is pretty safe to say, Leith.
Yeah, absolutely. And when we're talking about house prices, we're talking about new demand. So if you're already in the market, like that has an impact on the economy, how much people spend, their disposable income, that sort of thing. When you're talking about actually setting house prices, it's set by the marginal buyer. So that's people who are buying and selling homes. So, someone like me who's got an existing mortgage, whether my mortgage rate goes up or down doesn't impact house prices.
No, that's right.
Living here. But so certainly after the February rate cut, we did see a bounce in CoreLogic's, or Cotality, I should say, daily dwelling values index. Now it has petered out, but it lasted several months. We're now in the lead up to this rate cut, because it was widely expected, we're starting to see auction clearance rates, etc., tick up, and most people believe that we're going to get now another tick upwards, based on buyers know that there's been a rate cut. They know they're feeling more confident about buying. They know it's going to cost them less to service that mortgage, so you get that bounce in demand, and I'd say it's almost instant, really. So I wouldn't be surprised if we have decent auction an uptick in auction clearance rates this weekend, for example.
Yeah, well, I think anyone who's ever been on a list, and I feel like it's been a long time since I've a similar position to you, Leith. Long time since I've been out there actively looking, but I know that I'm still on mortgage brokers' lists from whatever time, and this is anyone who's ever spoken to one will be flooded by emails. Hey, you just, what a 25 basis points cut. Now you can afford to get this. Now you can, whatever it is, it's a sales, for them, it's a big sales pitch around. And so
I've received 2 calls this week, Damien.
Yeah, and they're pushing straight away to go, yes, let's try and get people, and at least even if they haven't actually seen the rate cuts in the actual numbers yet, they'll be doing it in their calculators and talking about, oh, now you can afford to spend this much more, and maybe you can get the house that you really wanted. Okay, so there's that. The other question, there's one about from David about the lowering cost of new dwellings. I might get to that in a minute, actually, some of that supply side. On the Max has got a question about Australian government bonds continuing to drop with the cuts, or is there a chance that US bond issues will affect our bonds? Now, this is sort of important one. I don't know, we've got some, my rough thought on an investment side is the long-term bonds very much get tied to a sort of global long-term bond one. And so, certainly your 15, 20-year bonds, if all global bonds, or particularly US bonds, are moving up or down, Australia tends to get dragged along with what's happening in the US at that end. At the shorter end, at the 3-year, well, actually, if we go right back to the 1 year, the 1 year is just tied to what the RBA is doing and what the odds are around that. Like, that's just a statistical calculation that people are making about how many rate cuts we're going to see and stuff like that. And so, and then that just gradually builds its way up. So at sort of a 3-year rate, it's mostly Australian RBA expectations and a little bit what's happening in global interest rates. Once you hit the 30-year, say, it's a lot about global interest rate assumptions. But so in terms of government bond yields, depends on where you're playing on the cycle. And I think that's probably highlights for me what the really big factors are. And I'd be interested to see if you've got anything to add to these, Leith. But for me, I'm saying, okay, what's going to make Aussie interest rates fall faster? A US recession, what's happening in China is probably just as big. So the US and China, if you saw, I guess, a US slowdown, but tariffs ticked up in China, and you saw a massive industrial slowdown in terms of China, Australia's so leveraged to that. That's going to affect us. And then the third one's in domestic conditions. Do we get a round of bad debts, or do you get something go on with that? And I think that's probably the less likely one of those, or that's probably more, that's the Australian economic conditions is you probably need the other two to have a bit of a fall into a bit of a hole before you run into Australian economic conditions. I don't think we're really looking at anything independent of say the US or global growth and Chinese growth, Leith.
Yeah, I think you summarised it beautifully. Absolutely, I think global conditions will be the predominant driver, and they'll also probably be the driver of a domestic downturn as well, if we are to get one.
Yes, yeah. So you sort of look at, and sometimes you get countries that just sort of they diverge from the rest of the world. Whatever it is, they've got some sort of boom going on. They've got all this debt that suddenly appeared, or some new accounting trick, or whatever it is that creates this issue that builds up, and that can sort of, you can see countries diverge from the rest of the world. But Australia is, especially given how much we trade, is very much tied to what's going on elsewhere. Right, so that's that was thoughts on interest rates. We're going to stimulatory policies and lending. So new government in. What's happening in terms of the changes, particularly the 5% deposit scheme is important. But I'll flick across to you, Leith, please.
Yeah, absolutely. So obviously this year we're going to get more rate cuts. So we've already had 2 this year. We're likely to get several more before the year's out. So that should obviously stimulate the market this year and into next. But next year we also then get a whole suite of demand-side stimulatory policies from the newly elected government. So during the election campaign, the Albanese government promised to allow all first home buyers to purchase a home, so new and existing, the whole lot, with only a 5% deposit. And they'll do that, and this comes in on the 1st of January next year is when it's scheduled. So, it could potentially lead to some first home buyers holding out, which could lower the price growth this year before they jump in next year to take advantage of these measures. But under this policy, taxpayers, the government, i.e. taxpayers, will effectively guarantee 15% of all first home buyer mortgages, which means that first home buyers only have to put down a 5% deposit, and they don't need lender's mortgage insurance. So I'm being a little bit cheeky when I say this because it's not technically true, but I previously described it as a state-sponsored subprime mortgage scheme. because we're going to be bringing in a whole bunch of people who otherwise wouldn't be able to buy them with very low deposits down. And obviously, this policy is going to increase their capacity to pay. It's going to bring more buyers in the market sooner, and logically, it should help to push up house prices. And another measure that was announced.
So before you get to that one, so basically, this is one of these classic thinly veiled. We're trying to help out first home buyers, but actually, what we're really trying to do is boost the housing market.
Yeah,
and so it's a zero sum game. Yeah, a few people get in, but all existing players get their house prices up 5-10%, and so they're all happy, but it actually just makes it harder for the next generation coming through.
And it makes it a lot worse because obviously if people are buying with just 5% deposits, they're taking on more debt, and ultimately you're going to end up the extra demand is going to be capitalised in the house prices eventually. So if you're a first mover, you might do okay out of this. Like if you're one of the first tranche who gets in before prices go up, but if you look at say my teenage children who might be looking to buy in 10 years' time, once the price is capitalised in, they'll just be in a worse position because they'll have to buy with a 5% deposit and pay a lot more
debt.
Yeah, that's it. They'll basically paying a lot higher prices than they would have otherwise.
Yeah.
So effectively, you end up with a more expensive housing market with households carrying more debt. So it's self-defeating from an affordability perspective. It's also worse from a financial stability perspective because households will be carrying more debt. And it obviously means that if we ever did get a house price crash in the future, like a significant one, taxpayers could be on the hook for the 15%. That's not.
Yeah. Well, that was where I was going to get to for that. There's two things I should talk about.
Liability, those.
Yeah, one is this. If you are going to save, if you're in this, or you got kids in this, or nephews and nieces or whatever, and you are saving for a first home, make sure you're using the first home buyer super scheme. So you can basically use your tax rate in your super fund to save at a much reduced tax rate. So you're going to get there 25% faster. If you're the average person on sort of 100 grand, or I think basically above, if you're in the 30% tax bracket, so I think it's above 45,000 or something, you're going to get there 25% faster if you use this. If you're on any tax rate that's higher, you might be getting there 30 or 40% faster by using that, because you're basically getting huge free kick from that. So that's a pitch for our product. If you need any help, speak to us. But the second thing along those lines is that if we're talking about this first home buyers sort of loading in, is the question about saying, I guess the delay in this is about saying that. Sorry, I've lost my train of thought on that one. I was did my sales pitch and then I forgot where we're going with this. First home buyers grant. So yeah. Anyway, actually, I'll go back to you, Leith. I'll remember what the second point was.
Sorry, mate. It happens to me all the time.
Yeah. That's right. When things go wrong, sorry, I remember what it is. So the issue with when things go wrong with these ones, so let's say you are building a new subprime, and the Australian government is basically going to be on the back. It turns into basically that there's like what happened in the US. All of a sudden, we built up this massive subprime market, all funded by the government, and everyone's basically putting it onto the back of the government. Is like, great, I can take out these loans, 5% down. If anything goes wrong, government's on the hook for the mortgage insurance. Who cares? And the bank starts shoving it down. That's going to take years or decades to play out. Like, that's not they'll do this and in 18 months' time we'll see a big financial blow up and a housing price, whatever it is. This is it's sowing the seeds of a structural issue that you'll build up over time. And in 15 years' time, you'll have this massive, as you said, subprime first home buyers thing building there that everyone's trying to shove as many people as they can. And you need to get, all the banks will be lobbying furiously for the government to get more immigration, so you can get more people in to get the first home buyers and all this stuff like that. And that's so you might be worried about that being a financial blow up, but that's not even tomorrow's problem. That's the day after tomorrow's problem in terms of a fair way down the track. It's not great policy. Big chance of financial issues can go wrong, but just not for any time soon.
Yeah, and it's also a structural policy band-aid on top of a band-aid, because we've been doing this stuff for the better part of 25 years with, first home buyer grants, tax policy, all sorts of stuff that's just added demand-side measure on top of demand-side measure that has completely warped the Australian housing market and I'd argue warped the economy. and we're effectively doing more of the same. So this is just doubling down on stuff that we've been doing for the last 25 years, pretty much.
Which all, as I said, it all worked. It was basically what they wanted. We wanted house prices higher, and we didn't really care about first home buyers. It was just we wanted something we could say we felt strongly about first home buyers, but really what we cared about was existing home buyers. And so it's a bad policy, but it's worked in the past. Keep pulling the same lever.
That's it. Just keep kicking the can. So some other policies, and these are minor in the context of the 5% deposit scheme, but also I think it was in February, the Albanese government directed the financial regulators to therefore direct the lenders or the authorised deposit-taking institutions to exclude student debts from loan serviceability calculations. So basically, going forward, I'm not sure if it's come in yet or it's about to come in, but it was announced lenders won't have to consider HEX debts when they assess people for their mortgage serviceability. And Compare the Market did some analysis, and they said that they found that if for somebody on, say, $100,000, they'll be able to borrow $56,000 more. And if you're on, I think it was 140,000 or 150,000, which is obviously the very top, peak of first home buyers. There wouldn't be too many of those, but they could borrow, I think it was $96,000 more under this policy, just this one policy alone.
Right.
But it's just another thing to add a little bit more borrowing capacity, ability to pay, just more fuel on the housing bonfire.
Yeah, and we already got that. That was the we had that reversed last time, didn't we? Where they were saying, there was the case out there against Westpac saying no, you can't use the poverty threshold in order to assess how much people can borrow. You should be using their actual expenses. And then basically, the effect was they ASIC lost that case, or APRA, whichever one it was, APRA.
Anyway, ASIC,
yeah, lost that case, and so it's basically the banks you might have BMW lease payments, kids in private schools, all these other ongoing expenses that you've got. You can just say I'll forget the fact that that's the case. Forget the fact I'm spending $50,000, $100,000 on sending kids to private schools. Just exclude that from the calculation and ramp me up. So
yep. And their thinking there was, well, you can always pull your kids out of private school, and you'll do that to pay your mortgage. I think that was the thinking behind that decision. But it is what it is. Another one, Labor also expanded the number of places for its Help to Buy shared equity scheme, which allows, which basically means that the government will take a 30 to 40% stake, depends on whether it's a new property, existing property, etc. They'll effectively co-buy a property with you. Which again means that if you're, a marginal buyer who otherwise can't afford to purchase, you can then get into the housing market, purchase a home. You can pay more than you could otherwise because you're only paying for 60 or 70% of it. But it's just another one of these demand side measures that puts some marginal upward pressure on house prices. So they announced an expansion of that. So those three policies are basically, especially the 5% first home buyer deposit, that's the main one. But those will just add further stimulus to the market on top of the cuts in interest rates, which inevitably will just end up, being capitalised into house prices. And on top of this, we've also seen some lenders bring out some new products to add more fuel to the fire. So we've seen some lenders come out and start offering 40-year loan terms. So years ago, it used to be, I think my parents bought it was like 15 years. It was talking back in the 70s or early 80s. And then it went to 20, 25, now 30-year loan amortization periods are the norm.
Yep.
Now lenders are increasingly starting to do 40-year loan periods.
Japan's got 100. So
yeah, that's it.
We'll get there eventually. Yeah.
That's it. We've got a long way to go. We could have, multi-generational ones coming up soon.
That's right.
Or you just pass on to your children. So in your will, you got my mortgage as well.
Yeah. Excellent. Actually, before we get to the next one, let me just go to a quick sales message.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Right, sorry, one more that you wanted to go on, and I missed this one. So this is just last week, is it? So we've got 10-year interest-only terms without reassessment. Do you want to talk?
Yeah, that's it. So this was, it was either last week or the week before. Certainly this month. I lose track of time now because the weeks are just molding into one. But AMP announced that they've introduced a 10-year interest-only loan terms. So this is for all borrowers, not just first home buyers, it's for upgraders, investors, etc., whereby you can buy a home now with a 10-year interest-only deposit with no reassessment during the loan term. So you don't have to, if circumstances change, you don't have to get reassessed. You've got 10 years to basically only pay interest back on your mortgage, which again increases capacity to pay, or increases your borrowing capacity because you only have to pay interest, not principal and interest. And it's just another measure on top of everything else, which will add some, marginal upward pressure to house prices.
Yeah, that's interesting. And there's one more as well that you said is there definitely, could there be could this have an unhappy ending at some point? You go, yeah, that's exactly the type of thing where, look, the Australian government is pretty dedicated to keeping house prices high, but if you ever run into sort of major economic downturns, say Trump did go through with a bunch of economically damaged one, or you end up with a major war, or whatever it is, you end up something quite bad that ends up in a house price downturn. These are the types of things that end up making it way worse. It's goes from being you get house prices fall 10-15%, and the next thing you know they're down 25% because these types of policies where people geared up and then they just have to get out.
I think the bigger issue is not so much a house price crash like that. It's more just the warping of the Australian economy, whereby for the better part of 25 years we've just funneled unbelievable amounts of resources and capital into pumping up house prices rather than doing anything productive with it.
Yeah,
and that's the so our entire banking system has been geared towards lending for housing rather than trying to lend for new businesses, venture capital, all this sort of stuff.
And lending on existing housing as well. That's the other thing, isn't it? Like you can have some sympathy if you've got these policies designed to say, let's go out and build new stuff and get new capacity on, especially if you are packing as many people in as you possibly can, and you need to expand your supplies. You go, okay, policies to expand existing supply make some sense, but policies that basically geared to driving up demand and not changing supply are the ones where it's just going to add to prices. There's no
absolutely
benefits for it. Right. Okay. So that's the stimulatory policies and lending. We might go back and have a quick look at some of those other charts we've got there. So population demand then.
Yeah. So this is a bit of a disaster. So viewers might recall or might recognise that obviously we've had a period of record net overseas migration in the country. So we had about 1 million net overseas migrants arrive in the first 2 years after the Albanese government was elected, which was off the charts. I've never seen that before. But last year it did look like net overseas migration was falling. So from a peak of about 560,000 back in 2023, I think it was, by the September quarter last year, which is the most recent quarterly data we have, net overseas migration had fallen to 380,000. So just to put it into perspective, that is still higher than any other time in Australia's history before the pandemic. So the highest before that was 2008, we had 310 or 315,000. So still very high.
It's not quite double, but it's pretty close to double the average we've seen over the last 10, 20 years.
Yeah, it's very high. So, but all the sort of partial data that you get. So every month the Australian Bureau of Statistics releases its net permanent long-term arrivals data, which is basically a proxy for net overseas migration. And it's a monthly release, and we've received that up to March. And what that shows is that if you go by that, net overseas migration has rebounded back up. Now there's a chart there in the bottom left from Justin Fabo from Antibody and Macro, and you can see that's the orange line. It's rebounded back up. We've had very strong arrivals in the first 3 months of this year, which suggests that net overseas migration has picked up. Also, temporary visa numbers student visa numbers are all basically at record highs again. And even the monthly labour force release that came out, was it last week, for April, its civilian population data showed that it's rebounded as well. So it looks like immigration's picked back up. Now, on the supply side is terrible. So we're building about our housing construction rate currently is tracking near decade lows. It's very poor. We've built about 170, just over 170,000 homes in the last 12 months, going by the latest data. Now, the National Housing Supply and Affordability Council, that's the advisory group. That's the government's advisor on housing supply. It released its 2025 report on the state of the housing market just yesterday, or sorry, this week, I think it was. It was either yesterday or Tuesday. And what it showed, or what it forecast, is that the government is going to miss its housing target. So the government's got a 1.2 million homes over 5 years target, which was never realistic. It was never going to be achieved. But it said it's going to miss it by about 262,000. So, roughly 20 odd %. And the table there in the middle of that basically shows the shortfall between supply and demand.
Yeah, for anyone watching this on their phone can't read it, it's basically showing, gross new supply of 177, net new supply, just because a lot of those are knocked down and rebuilds, of 155,
demand
and then demand of 240.
Yeah, and so what the report said, it said that we're going to have ongoing strong high immigration. We're going to have demand well ahead of supply over the next 5 years. And we're going to have a cumulative shortfall of 79,000 homes over the next 4 years. 5 years.
But having said that, though, that seems crazy optimistic still, in that it's basically saying, okay, we've got this net new supply at 155,000 going to 173 over the next sort of 5 or 6 years, which is that's there's just not much you can do in terms of ramping up. You can't suddenly turn around and go, we're going to build 50% more houses, because you just don't have people to build it. So, and companies and all that stuff. So so that's sort of ticking up, growing at a pretty rapid clip. That sort of looks like anyway. That's growing at a reasonable rate. Where all their forecasts are coming back to that number, though, is just a net new demand is going to fall from 240,000 back to 170.
Absolutely. So they are basically using the federal budgets or the government's own migration forecasts, which have already been shot to pieces or are currently being shot to pieces, as you can see on the chart on the left. So their net demand figure is optimistic. So they're assuming that migration falls back down to its pre-COVID average of about 235,000 a year. When
evidence says to the opposite.
It probably won't happen. At the same time as they expect supply to rebound, which who knows, it doesn't look very likely. But even with these rosy assumptions, they're saying that we're going to have a shortfall of homes of 79,000 over the next 5 years. Now that doesn't mean a total shortfall. That is an addition to what we already have. So there are, Shane Oliver from AMP and some others have done research, done estimates suggesting that the shortage of homes in Australia is currently tracking above 200,000. So with this, it's going to be close to 300,000 if you just add these two figures together. And that's based on these, fairly optimistic assumption, I'd assume. But no matter which way you put it, we're not going to build enough homes to keep pace with population growth, which means that the only logical solution when you have that situation is to cut immigration. So you've got to cut the demand side. Now, what the report said, sorry, I just add this one last point. What the report also said, the National Housing Supply and Affordability Council, it said that the rental crisis is going to get worse, is what it's flat out said in its report, because we're going to have this ongoing imbalance between supply and demand, the demand comes from population growth, i.e. immigration. So we're going to have this ongoing rental crisis because the federal government is basically continuing to fire hose additional renters. They're importing renters into Australia's housing market when we can't build enough houses for those renters.
Yes.
It's a disaster.
And anytime I look at a report and it says, I have two variables here. One variable I've got growing at 2 to 5% per annum over time, and the other variable I have falling by 40% over a 3-year period. You got to look and say, well, what's been the history of this? And as we just showed, that's the history is they don't really have much control over. Well, they probably do from a big picture policy setting, have control over how many people are in. But they seem to be passengers on this, as opposed to they'll set up their policies and then they're like, this we're going to bring down the number of people or whatever, and then they'll be like, oh, actually the number of people rose. Oh well, let's go around and reset. We might tweak our policies at the edges about students or whatever it is, but it's not. They're not really driving it. They're not, in terms of how many people are coming through.
Yeah, and often so I'll just use international students as an example. They'll use workarounds to get around the policy. So what they're doing at the moment is we've got record numbers of bridging visas in Australia. So effectively, students, once their visas expire, many are refusing to go home, and they can put a spurious claim into the Administrative Review Tribunal. It used to be the AAT, just changed its name, and effectively they go on a bridging visa, which means they can keep all the same work rights and everything they had before under their old visa, and they can stay in the country for years while the backlog of the Administrative Review Tribunal gets worked through, which takes a long time. It's got literally hundreds of thousands of cases on the backlog. So there's all these ways, so as a result, you have less migrants leaving than they expected, alongside very high arrivals, which means we just have ongoing high net overseas migration, high housing demand, that sort of thing. So, yeah, look, it's not a pretty situation, and unfortunately, the rental prices that's already, obviously in a very poor state, is going to continue as long as we continue to import more people into the country than we can build houses for. It's not rocket science. This is all pretty basic stuff. And unfortunately, the federal government's own advisory council has got it here in black and white. Obviously, they use, bureaucratic type speak. They're not as blunt as I am. The data's there for everyone to see. And they don't believe the federal government's target. They say it's completely unrealistic. And yet and even with their, Panglossian assumptions, they say we're going to get a worsening housing shortage. So it's not great.
Yes. Quick sales message, and then we'll talk about investment implications.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
Just before we get onto the investment view, so I just thought it was worth talking about some of the political implications of this, because I think the lesson that, when I look at the latest federal election, there's not a lot of support for either major party, and I would suggest that a lot of the landslide, so to speak, win we got from Labor was actually on a really low level of primary vote, was actually more about the failings of the Liberal Party than it was about the wild successes of the Labor Party. There's sort of like a mild drift back to Labor. Still, everyone's voting for third parties, but the Liberal vote collapsed. And given that there's sort of this, they're swinging back towards the middle, it seemed to me that they're probably trying to go against sort of Trumpian policies, so to speak. Is the view that they're learning is saying, well, do we want policies that Trump have? We probably don't. That seems there seems to be a pushback against Trump. And one of his policies is crack down on immigration. And so I wonder if that's a lesson that the Liberal Party is going to say as well. Let's just not crack down on immigration as much as we might have said. Like they're the one party that was, not the one party. There's a couple of other parties, a couple of other right-wing parties, say Pauline Hanson, that are never going to get in that are supporting that. But they were at least sort of paying a little bit of lip service to slowing down on immigration. I'm wondering whether your thoughts are on whether they'll backtrack on any of that now, and so we won't have either of the major parties even talking about immigration as an issue.
Yeah, well, I mean, I certainly hope not. I think if the housing crisis keeps getting worse, and we have, and say the forecasts of the National Housing Supply and Affordability Council play out, or it's even worse than what they've said, there has to be a backlash at some point, you think. But, I think the problem with the coalition was they sold everything. They sold all their policies really badly. So in between, amongst their policies, they actually had a few good ones. I think their immigration policy was actually, while they were right to argue to bring it down. They were completely wishy-washy with it. They were contradictory. They couldn't explain it because one minister would say, one member would say something, and then the other one would contradict them, and there was no, and also they were contradictory in that they opposed student caps last year. They opposed Labor's student caps, but then argued for. So very, very untrustworthy. I guess they were contradictory. They weren't consistent, and they weren't trustworthy.
Yeah, it seemed like everything was we just wanted to try and wedge the government on something.
Yeah.
But we're happy to take opposite positions as long as we can wedge them. Yeah.
Yeah, but it was also, then you point to something else and say, well, hang on, that doesn't go with that. So it was pretty bad. But then you'd have some nuggets of good policy, like the gas reservation policy is excellent. And unfortunately, to your point, I hope we don't get the good ideas thrown out because of the election result.
Well, I guess where I'm getting to with this though is that I think you could, if you had a strong option in terms of that was out there banging that drum on a regular basis of there's too many people coming in. We're happy to have immigration, but there's too many people coming in. We need to slow it down to levels where we can actually build the right number of houses to populate these. We need to get young people into the houses at a reasonable price. If you had somebody out, a strong opposition party doing that, then you'd force the government into policies that might, wind back on those. But it's hard to see the Liberal Party coming out strongly on anything like that. Labor Party is obviously, happy to just keep things going as however they are. And none of the others are, the Teals aren't. This isn't one of their bugbears. They're probably they've got some pro and some against on that. And then you've got the Greens who have your contradictory policies in terms of this, where they want to put rental cap. They're out there trying to do it in some respects, wanting to put rental caps on, but on the flip side, wanting to get as many people in as possible. And so I guess what I'm saying is I don't think any of the major sort of possible ones out there aren't going to be arguing the case. And so it probably just won't be in the national debate.
No, and it's a very easy argument to make. That's the ridiculous thing. Like, it is actually a very easy sell. But and hilariously, Canada and the UK have moved to slow immigration significantly. So, and I'd argue that Canada's even more, although, Mark Carney's now looks like he's sort of trying to backtrack a bit. But, those countries are arguably more woke than Australia. So, it's just, it can be done. But unfortunately,
it's not looking likely.
No, and the problem with the coalition also got conflicts, right? So they're trying to kind of bend the knee. So one of their stupid policy proposals in immigration, which I only learned about after the election, I wish I'd known about it earlier, was they want to actually expand the number of hours that international students can work.
Right.
They want to make so instead of 24 hours a week, they want to make it 30 because that would make it easier for employers. But that would just turn student visas into backdoor work visas and would bring more students here, more spurious students. And they also want to expand,
you want to keep wage growth low.
Yeah, that's it. So look, the coalition, although they said they want to cut immigration, did they really?
Now, investment outlook. So I've got a table up here, which I sort of, I use to sort of talk through the last sort of decade or so of house prices, where I look at credit factors demand factors being credit availability, the price of credit, employment, population growth, foreign buyers, tax incentives, money laundering. And then the supply factors of being restrictive planning, under and oversupply, structural change, and defaults. And so basically, during the boom years, 2012 to 2017, basically everything was all green. It was all up, lots of credit, price of credit falling. You had a bit of a bust in 2018 where the credit availability suddenly fell as we had the Royal Commission. But then we're back on, sort of pre-COVID into just sort of a more neutral environment. Then during COVID, we sort of had this, factors working in different directions. This big drop in population and foreign buyers, and at the same time, we had massive increase in the amount of credit available, and the price of credit really fell as trying to bring people on. Post-COVID, we had this big rise in the price of credit, and that sort of stymied house prices a little bit, and a few other factors sort of back and forth. And I guess what I'm looking at is this outlook. Sorry, and I've titled the outlook 23 to 24, but it's actually meant to be 25 plus. So I sort of go through that and go, well, credit availability looks, pretty good. Like we've got all these measures trying to get more. Maybe I've understated that. Actually, maybe it needs two little up arrows rather than one up arrow. Price of credit is falling, not dramatically, but it's falling a little. Employment sort of seems to be a neutral one. Wage growth's looking better, but it's from pretty low rates. Immigration, population growth looks great. Foreign buyers, I'm not quite sure on the foreign buyers. I haven't got anything either way there. Tax incentives, we've got lots of tax incentives coming out, and money laundering. Actually, I'm not even sure what we're up to with money laundering. I know that was mooted for it, but it keeps getting kicked further down. So I don't know what your thoughts are on any of those. Where I've got it wrong.
So foreign buyers, Labor's committed to ban temporary foreign buyers for a couple of years, just like the coalition did. So, but to be honest with you, I mean, how much impact is it going to have? Like, I guess that could be a very tiny negative. And the money laundering thing, Labor did actually implement the tranche to any money laundering laws. Though they said that they would implement them, which is the first time since I worked at the Treasury back 20 years ago when they were being created that the government's actually committed to doing it. But I don't think that comes in until I think it's mid next year, if it does come in, and it's probably going to go through a whole bunch of consultation and all that, and probably getting watered down anyway. So if it does have an impact, it's not going to have an impact till mid next year anyway.
Yeah, and there's always the thing that, as I said, I think we had certainly within the financial services, there was a bunch of things that were definitely going to get done in the last term, and then once they got sort of 6 or 12 months out, they were like, oh, a bit of Senate pushback, we'll just wait.
Yeah, or they always say, it needs more industry consultation.
That's
right. They just kick the can.
Yeah. So, right. So So I've always got my cynical hat on for those ones. Is that if that's the case, and for anyone who hasn't listened, we've got a couple of podcasts out. There's a guy who wrote a book we had on maybe about 2 or 3 years ago. Just
Nathan.
Oh my God, talking about this. And so there's a podcast out there about that, and just about how bad Australia is relative to the rest of the world, and how Australia is the lucky laundry is what it's called. Just about how much money laundering goes through Australian property, and it's sort of that. It said none of these are like going to blow up the Australian housing market on their own, or they're going to create or whatever, but it's just all these little things where everything's just sort of all pointing in the same direction, and nothing really particularly negative. And so maybe that money laundering could turn around the other direction if all of a sudden they went, yes, tranche 2, and we're actually going to force property real estate agents and solicitors to make sure they know where the money's coming from. But at the moment, they keep talking. They've been talking about doing it for how long now?
Oh,
20 years?
25. 2004. No. When I was at Treasury in 2004, they were devised. I think 2005 they introduced it. So about 20 years.
Because it was all post World Trade Center. So that was 2001. So probably 2002, 2003 they started talking about it, and we've been Yes. Okay. Then on the supply side, so restrictive planning. So I don't think there's any particular changes to the planning process that I've seen. Everyone wants to complain about it and say, it's all local governments or it's all state governments or whatever the case is, but it's all mucking around the edges. Unless I've missed anything on that side.
Yeah. Look, I think Tim Gurner, who's a prominent apartment developer, said it best. He basically said that he predicted a 15-year rental crisis. I think earlier this week or last week in the AFR, and he said that you can do all the things you want to do with planning, but it's not going to make much difference because construction costs have gone up. We got don't have enough labour, etc. So it's not going to move the needle anyway.
Yeah. No, that's it.
At least not in the medium, even short to medium term.
Yeah, because there is this issue, isn't there, around this whole construction costs, and they talked, and there's a little bit of debate about. Well, there's certainly allegations that the productivity in the Australian building sector is going backwards, and at quite a rate of knots. And then there's questions about are we measuring it properly and all that type of stuff. But I guess what I'm wondering is, it seems to me that when you look at housing costs, it seems to be that people have this sort of rule of thumb about, look, I've just shelled out $800,000 or $1 million for a block of land. I'm not going to stick a $200,000 house on it.
Yep.
I'm going to spend whatever, at least half the amount or more than, or the same amount that I'm spending on the land I'll spend on the house. And so it's this question about saying, do we have anyone out there who's actually going, I'm just going to build these things as fast as I can. I'm going to, whether it's prefab or it's just building smaller houses or whatever it is, but it's just like going, I'm out there going, buy it, build it, move on and get to the next one. Whereas it seems to me that no, that's not the case, because people have to spend so long saving up. By the time they're getting there, they're much older, and now they're, and other houses in the, there's this whole, you don't want to be the, you don't want to undercapitalize what you're spending on this, and so people are just paying up for the for whatever it is in terms of the we're potentially spending more on a house that might not be significantly different, I suppose.
Yeah, I think that's spot on. But there's also another reason why productivity stinks in the housing construction space is because there's been a massive blowout in back office people in the construction sector. So Australia has one of the highest shares of construction workers in the OECD, but some data came out from I wrote it up the other day, Macro Business, and actually showed that the fastest growth in the construction workforce has actually been back office people, not tradies. So not people actually building the homes. It's been the not really bureaucrats, but the suits,
compliance,
suits. So a lot of the construction workforce, a lot of the growth in that has been suits in the construction industry, and as a result, that is one of the reasons why the construction productivity has fallen, because the output per worker has tanked, because you've got less people actually building the homes as a share, and more people doing all the compliance and all the other BS that goes around it.
Yeah. Well, and I think as well, like for anyone who's done any of the been involved at all in the building industry, there's the part about going, if you're building something to whatever standard, it's like, yes, it's an acceptable standard is whatever it is, and you're tiling a bathroom or whatever, and you're like, yes, it's acceptable to a little bit of water pooling here or there or whatever it is, and that's, we're going to get this in and get it done quickly and get it up and running, versus someone who's gone, no, I'm shelling out $1 million just to do this. I want it, I want everything perfect and level, and none of the things, and so the time taken to go back and might be double or triple the time, if you know what I mean. If you're trying to if you're going, look, I want to get to the 98th percentile, you're like, yes, I can do that pretty quickly and easily. But then you're like, oh, well, to get to the 99th or the 99.5 percentile might take double the time. And so there's that, the more you're building of high quality and things like that, just takes dramatically more time than what it does to bang something up quickly. And we don't have anyone doing it. Okay, the other thing then, under and oversupply. So a lot of words about developers collapsing. You see that on a relatively regular basis, just with this whole the cost of construction just going up time after, and some of that's, or a reasonable amount of that is related to, as you said, that the compliance side, but there's also the energy costs as well.
Yeah, so the cost of materials and all that sort of thing has gone up about 40% since the pandemic began, and so the imported cost of materials has gone up, but also the domestic costs. So there are some parts of Australian manufacturing cannot be offshored. So for example, if you're making bricks, for example, that has to be built here because they're so heavy, they're expensive to transport, they're difficult. But the cost of making bricks has gone up a hell of a lot because energy prices have gone up. So you obviously need gas-fired furnaces to create bricks, and we've got very expensive gas prices. So as a result, you end up with higher materials costs. So part of it's just the price has gone up everywhere, but also part of it's Australia's high energy costs are making it more expensive to build housing as well. And unfortunately, the construction costs have gone up so much that a lot of builders can't turn a profit at current prices, which is one of the reasons why we don't have enough construction. It's also why construction insolvencies are tracking at more than double their pre-pandemic level. So we have basically record construction insolvencies. And there's one other point, Damo. a lot of the policymakers say, oh, we need to build apartments because apartments are cheaper, etc. They're actually, it costs a lot more to build an apartment than a house. So the actual cost of the building an apartment structure costs, the per apartment costs more than building a house.
Right.
And so that's coming from the actual ABS data. It is a lot more expensive to build apartments. So this whole notion that we can just build high-rise shoeboxes and expect to solve the housing affordability crisis is completely unfounded. Although the land costs will be cheaper, obviously, the construction cost is a lot more expensive than building a detached house. Also takes a hell of a lot longer. So to build an apartment takes a lot longer than it does to build a house. So unfortunately, the maths just doesn't add up.
Yeah. Yes. So, and that's coming back to my structural change. I guess that's probably one of the things I could say, look, is there a slight negative in that, insofar as during the pandemic, there was a big push for people to have fewer people per household. Everyone got locked up, and so all of a sudden said, oh, well, maybe I want one fewer flatmate or whatever it is. And so that sort of desire for houses versus units and a bit of spread as well, to say, well, more regional demand and versus city demand. I guess my expectation is that's probably coming back a little bit now. It's probably starting to, there's just that, that initial push out has sort of created a bit of a structural issue, but now that's coming back the other way. And so there's probably a slight negative, but not enough to knock out any of the other positives we've seen.
Yeah, and actually the National Housing Supply and Affordability Council's report actually mentioned that we're going to have more grouping. So there's a chart in there showing that the number of people per dwelling has actually been increasing. And part of that's in response to this affordability. It's kind of reversing what happened during the pandemic.
But just the availability as well, isn't it? It's the same. Right. You've just got to get to the stage where I'd love to live with 3 flatmates, but rather than 4 flatmates or 5 flatmates or whatever the numbers are, but if you just can't find anywhere that's available, then it's got to change.
And I think it's actually one of the reasons why the projected shortage from I need to double check this because I should have actually checked that because I just thought about it now. But they did mention in their report that they expect more group housing in response to the high rental costs, etc. But that might also be one of the reasons why their projected shortfall over the next 5 years looks a bit optimistic. It could be because they're assuming that we have more group housing. So as people move into group housing, you need less houses, obviously, even though it's suboptimal for those people who have to share a home when they don't want to. It is one way of, I guess, alleviating the housing shortage.
Yeah, and I'm hearing as well from people that some of the land tax issues, land tax raises in Victoria are starting to bite in terms of people with second and third houses, in terms of saying, well, do we really want to pay this extra tax, or do we want to get that, especially for, say, a holiday house, for example, is saying, and that's where, there's certainly, so I think it's 10% houses unoccupied in Australia. Is that ballpark?
Yeah, I can't remember exactly. So it's census. That's also based on census data, which is a bit dodgy. In that, if you're away on a holiday or you're in a hotel that night, that'll classify your home as being unoccupied.
Yeah.
So it definitely is overinflated, that figure. But regardless, there would be a fairly decent proportion of homes that are unoccupied.
Yes.
At any one time. There's always friction in the market as well. Like, for example, when a rental property is sold, often they kick the tenants out first. While the for sale board is up, the home is empty. And so you're always going to have this, I guess, transitory,
Everyone needs a bit of a crossover when they're moving or whatever it is. Yes, even if it's just a month or 2 months where I'm like, I'm not getting out of this place until I'm into my new place, and
it's a bit like the labour market. So the labour market, full employment might be considered to be, say, 3.5%. Well, that's still 3.5% of people unemployed, but that's because there's a lot of friction in the market. People are changing jobs, all that sort of thing.
Yeah. Excellent. Anything we've missed that should have run through?
Not really. I just think, unfortunately, if you're like me and you don't want to see home prices go up because you've got 2 teenage kids, I think we're going to have to suck eggs, because I think the next, 18 months, 2 years is going to be, it's going to see another uptick in home prices. And unfortunately, the rental price is going to continue as well.
Yeah. Plus a productivity thing about saying, if people have to be spending 50 or 70% of their income on getting a house somewhere that they want, then they're people that aren't going to do something innovative or start a new business or be out there trying to grow the economy. And if people look at the housing market, effectively what we're saying, the way we're saying today is, look, it's all geared to pushing it up, and then people are saying, well, should I go and invest? I've got a couple $100,000. Should I go and leverage it up and buy an apartment and rent it out to somebody? Or should I take that money and either invest in a company that's doing something productive or new, or go and start a business myself, or do something that's actually going to sort of grow the economy? Is people are opting to say, well, the housing market's been such a one-way traffic, and we've obviously got a political class that feels like that's a great investment for people. So much of a great investment, they're going to start putting government money into it now. It's sort of not great for productivity.
And obviously, if you've got a big mortgage floating over your head, you don't want to take any risks. You don't want to try and start a new job or whatever.
Yeah. Yes, absolutely. Thanks everyone for the questions. There's been quite a busy, lots of comments as well as questions in there. I think we've answered most of the key ones. Thank you very much, Leith, for coming on. Just a reminder for everyone that you can get Nucleus on a whole bunch of different. You can get this podcast on all the major and minor podcast platforms. We're on every 12:30 p.m. every Thursday. You can jump on and ask questions that's on YouTube. And if you want to register, you can register on our website and get emailed out transcripts and summaries and all that type of stuff as we do the podcast. Thanks.